Welcome back to the Deep Dive. Today, we're taking a closer look at Proficient Auto Logistics, specifically their Q2 2025 earnings call from August 11th.
Yeah, and this one was interesting because, well, the headline numbers, the standard GAAP figures, they didn't look great on the surface.
Right.
But the market reaction, very strong. So there was a clear disconnect there. Our job today is really to dig into why investors seem so encouraged by the operational performance, even with that GAAP miss.
Okay, let's unpack that then. Because, yeah, the GAAP numbers, you mentioned they were a miss. EPS came in at -6 cents.
That's right.
And the street was looking for, what, +5 to 9 cents. So quite a gap there. Why wasn't that a bigger deal?
Well, in these situations, especially with recent M&A activity, GAAP can sometimes be misleading. It includes things that might be one-offs or non-cash charges related to integration.
Okay.
The market looked past it, I think, primarily because the top line, the revenue, absolutely crushed expectations. Came in at $115.5 million.
Against estimates around $105 million.
Yeah. Exactly. About $105.2 million was the consensus. So a really strong beat there.
Yeah.
That showed the core business demand was healthy.
And the volume numbers seem to confirm that strength, right? Units delivered were way up.
Way up. 631,426 units. That's 28% higher sequentially, quarter over quarter.
Okay, 28%. That's huge. But let's push back a bit. How much of that is just bolting on the volume from the Brothers Auto Transport acquisition they just did versus, actual organic strength or execution?
That's a fair question, and management did speak to it. The acquisition was definitely a major contributor to the volume jump, no doubt. But the key was how quickly they seemed to gain operational leverage from it. Do you see that in the adjusted operating income?
Right, that jumped significantly.
It really did. From $1.2 million in Q1 up to $3.8 million in Q2. A big sequential improvement. And that actually pulled the official GAAP operating income back into positive territory, just barely, at $0.1 million, but positive nonetheless.
Which leads us to probably the most watched metric for these guys, the adjusted operating ratio, the OR. How did that look?
That showed clear improvement too. It dropped from 98.7% in Q1 down to 96.7% in Q2.
So just for listeners, lower is better there. That's costs as a percentage of revenue.
Exactly. Every point, every tenth of a point matters hugely in trucking and logistics. Getting almost 2 full points of improvement in 1 quarter while integrating a big acquisition, that signals they're getting a handle on efficiency quickly.
So it wasn't just about adding revenue, it was about managing the combined operation better.
Precisely. It's an integration and network optimization story playing out.
And they talked about that integration, right? Getting Brothers Auto Transport folded in successfully.
Yes, they highlighted that. But crucially, it wasn't just about the trucks. They mentioned getting all the operating companies, legacy and acquired, onto the same systems.
The common accounting and TMS, the transportation management system.
Right. That standardization is key. It gives them the visibility they need to actually manage the whole network effectively, find those efficiencies, and ultimately scale up profitably. That's what the market is betting on long term.
Let's dig a bit more into those efficiencies. A 2-point OR improvement, 200 basis points. In this industry, how significant is that jump in just 3 months? Does it really justify that big stock pop?
On its own, maybe not entirely, but it points towards the potential, especially when you link it to free cash flow later on. Operationally, though, the gains seemed, structural.
How so?
They gave some specifics. Things like sister hauls, that's their term for sharing loads between the different operating companies, that increased to 9% of revenue from 8%. Basically less empty miles, more efficiency.
Right.
And also their own trucks, the asset-based fleet deliveries, increased as a share of revenue too, from 35% to 37%. That's generally a higher margin business for them.
And did that translate into, driver productivity?
It did, yeah. They quantified it. A 7% increase in the average weekly revenue per company driver, quarter over quarter.
Yeah.
So real execution gains there.
Okay, but there was one metric that looked a little soft sequentially, wasn't there? Revenue per unit.
Ah, yes. Ex-fuel revenue per unit was down about 3% compared to Q1.
Which, could make you worry about pricing pressure. Maybe they're discounting to fill those trucks.
It could, and they addressed that concern directly on the call. Management attributed it specifically to a shift in the customer mix. Meaning they had a higher concentration of certain customers with shorter average lengths of haul in Q2. Shorter haul generally means lower revenue for that specific unit moved.
Okay, but presumably still profitable work.
Exactly. They emphasized it wasn't about core pricing weakness, just the blend of business changed slightly quarter to quarter. And crucially, the business mix remains very stable overall. OEM contract business is still 93% of their transport revenue.
Very little spot market exposure.
Minimal, only about 2.7%. So it's a high-quality, contracted revenue base, which investors like.
Now, management has this longer-term goal, getting that adjusted OR down into the high 80s or low 90s. They just hit 96.7%. That's still a ways to go. How do they bridge that gap, especially if the overall economy isn't exactly giving?
That's the million-dollar question, isn't it?
Yeah.
And their answer seems to be because the macro environment is just okay, they have to double down on internal cost control.
Right.
They're actively pursuing more savings. Things like consolidating purchasing across all the companies, optimizing their physical footprint, facility locations, and finding personnel synergies.
Makes sense. You mentioned the macro. How is the auto market backdrop influencing things?
Well, it's not providing a huge tailwind right now. The SAAR, the seasonally adjusted annual rate for U.S. auto sales, it slowed down a bit in May and June, averaged around 15.5 million units. So demand is okay, but maybe not as strong as some hoped coming into 2025.
So that internal focus on efficiency becomes even more critical.
Absolutely vital. But there was some slightly better news on the external front.
Oh, yeah.
They mentioned that some of the recent uncertainty around tariffs and trade policy seems to have settled down, at least for now. And that's allowed the OEMs, the car manufacturers, to get back to their normal bid cycles for transportation contracts.
Ah, okay. So the process of awarding contracts is back on a regular schedule.
Yes, and that's significant. Management said they successfully renewed their existing contracts, importantly, at flat to slightly higher pricing.
Good sign.
And they also noted there's meaningful new volume out for bid right now. So an opportunity for them to potentially gain more market share, building on the Q2 performance.
Okay, let's talk guidance. What did they project for Q3 and the rest of the year?
For Q3, they're expecting the usual seasonal softness. They guided for a sequential revenue decline of about 2% to 5%.
Okay, typical seasonality.
Right. But here's the really interesting part of the guidance. Despite projecting lower revenue in Q3,
Yeah.
they expect to maintain the improved adjusted operating ratio they just achieved in Q2, that 96.7%.
So even with less revenue flowing through, they think they can hold on to those efficiency gains.
That's what they're guiding to. It really underscores their focus on margin discipline, maybe even over just chasing every last dollar of revenue if it's low margin.
And the full year?
For the full year, they're now expecting top-line growth between 5% and 10% compared to last year. So steady growth, but really built on that efficiency foundation.
Okay, let's connect this all back to the investor perspective. Balance sheet, cash flow. That's ultimately what drives the stock, right?
Absolutely. So balance sheet looked pretty solid. Cash was $13.6 million and net debt around $76.6 million. Manageable.
And the free cash flow, you hinted that was a big part of the story earlier.
It really was. I think this is what got the market so excited. Management put out a projection for an annualized run rate of free cash flow from operations.
Okay.
Between $30 million and $35 million. And that's after accounting for their expected capital expenditures for the year, around $10 million.
Wow, $30 to $35 million free cash flow. For a company this size, that seems quite high.
It is significant. And if you think about what that means relative to their market cap around the time of the call, that implies something like a 20% free cash flow yield.
20%.
Roughly, yeah. That kind of cash generation potential is huge in this industry, very capital intensive usually. That's why hitting those operational targets and improving the OR is so critical. It unlocks this potential cash flow. That's why the market cheered the Q2 execution.
And with that kind of cash potentially coming in, what are their plans for it? More M&A, paying down debt.
They sounded pretty disciplined.
Yeah.
They mentioned M&A is always something they look at, but nothing seems imminent right now.
Okay.
The main focus for the second half of the year, assuming they don't win some massive new contract that needs immediate investment, is going to be using that free cash flow to pay down debt.
Deleveraging. Makes sense. Strengthens the balance sheet, supports the long-term margin story.
Exactly. It reinforces that focus on discipline and profitability.
All right, time for our segment. This is not financial advice. We have to acknowledge the stock's roller coaster ride after this call. Huge cop, 24% in a day on massive volume.
Yeah.
But then it's given back a chunk of that, down about 17% from the recent highs as we record this.
Right. Quite a swing. And that volatility, that pullback, might create an opportunity or at least an interesting setup.
Okay.
The thesis here is that the initial jump was justified. The market saw the operational leverage, saw that huge implied FCF yield potential.
But the pullback
Suggests maybe the macro fears, the softer SAAR numbers, concerns about the broader economy, or maybe weighing on the stock now, overshadowing the company's specific execution.
So a disconnect between company performance and broader market sentiment. How might someone hypothetically play that?
Again, not advice, but one idea. If you believe in the management's execution story, could be something like a deep out-of-the-money bull call spread.
Okay, define that a bit.
You'd buy a call option with a strike price significantly above the current stock price and simultaneously sell another call option with an even higher strike price, both expiring maybe 6 to 9 months out, say, timed around the Q2 2026 earnings cycle.
And the logic?
The logic is it's a leverage bet. You're betting that management actually delivers on that path towards the high 80s operating ratio. They laid the groundwork in Q2 with a 96.7% OR, and that implied 20% FCF yield.
So you're using options leverage to capture a potential relief rally if future quarters, like Q3 or Q4, confirm that these OR improvements are sustainable.
Exactly. You're betting that they prove they can decouple their profitability to some extent from just mild slowdowns of the overall auto market through pure network optimization and efficiency.
Interesting. It's a bet on execution winning out over macro fears.
Essentially, yes. A bet that those regional efficiencies they talked about become the national standard and they hit that FCF potential the market got excited about.
So summing up Proficient Auto Logistics Q2, a quarter really defined by getting the integration right, showing strong operational wins, and painting a picture of impressive potential cash flow, even in a somewhat softer market. The focus was clearly on efficiency.
It absolutely was. And maybe the final thought to leave you with is this. Management explicitly stated that 3 of their 7 regional operating companies are already running at adjusted ORs in that target high 80s, low 90s range.
Right.
Already there. So the question becomes, how quickly can they really roll out those best practices, those efficiencies across the entire national network? If they can do that faster than the market currently expects, what does that do to their free cash flow generation? Hitting that target OR even 6 months ahead of schedule could seriously change the financial picture in the valuation story.
Something to definitely keep an eye on the pace of that national rollout. We'll leave you to ponder that. Thanks for joining us for the deep dive today. We'll be back soon to explore another set of sources.